Welcome to vTalkInsight, Market Drivers Daily for January 12, 2026. Global markets are starting the week balancing three forces: a U.S. push to rewire Venezuelan oil flows, a quiet move toward mortgage-style easing, and a rates market that is rethinking how much Federal Reserve cutting really lies ahead. Let's begin with the geopolitical and energy picture. Geopolitics and energy remain tightly linked, and the center of gravity is shifting toward Venezuela, even as the Middle East stays fragile. The overarching message is that spot oil balances still look comfortable, but policy and security choices around Venezuelan and Iranian supply could swing prices and risk premia quickly. That mix matters because it feeds directly into fuel costs, refinery margins, metals demand, and the appeal of traditional hedges like gold and oil majors in diversified portfolios. Washington has moved from rhetoric to structure in Venezuela, brokering deals that send tens of millions of barrels of crude to the U.S. and open the door to ongoing flows well beyond that initial tranche. The plan envisages at least $100 billion of private capital over roughly a decade to rebuild fields, upgraders, and ports. The U.S. intends to tightly manage which companies are allowed in, how equipment and light crude are imported, and where export revenues are spent, with a strong bias toward purchasing American goods and services. Gulf Coast refiners, already configured for heavy sour crude, and long-standing players like Chevron look structurally well-placed if the framework holds. Against that, near-term oil fundamentals still look soft. Forecasts point to an oversupply of around 2 million barrels per day, with base case assumptions of Brent in the mid-50s and WTI a few dollars lower, and a policy preference in Washington for oil near 50 to support consumers. U.S. production is running at record levels. Gasoline prices have dipped toward just under $2 a gallon, and lease auctions in regions like the Permian and New Mexico are clearing at record per-acre prices, underscoring long-term confidence in demand. Short selling in crude futures is elevated, while surveys show institutional sentiment on the energy equity complex still deeply bearish. The benign supply picture sits uneasily beside acute geopolitical stress. Protests and repression in Iran, including communication blackouts, combine with sharper U.S. rhetoric to keep a premium on Middle Eastern supply, even though recent oil price gains have been driven more by Iran than by events in Venezuela. At the same time, copper prices above $13,000 and tighter control of strategic minerals are fueling merger interest, but also regulatory and political risk for large mining deals. Gold pushing to new highs and rising interest in traditional hedges signal that investors are still willing to pay for insurance against an upside oil shock or broader geopolitical accident. The counterpoint is that translating Venezuela's reserves into barrels will be slow and uncertain. Output has collapsed from several million barrels per day to well under 1 million. Infrastructure is badly degraded, and oil majors remain wary about security guarantees, debt recovery, and the risk of renewed asset seizures. If prices were to fall below $50 for long, higher-cost U.S. production would likely retrench, offsetting some of any Venezuelan boost. Key watch points now are the fine print of security guarantees, the pace of sanctions relief, how Iranian unrest evolves, and whether heavy short positioning in oil is forced to rebalance. With that geopolitical and energy backdrop in mind, it is easier to understand why policymakers are simultaneously leaning on targeted easing tools, especially in housing finance. On the monetary side, the clearest easing impulse right now is coming not from classic central bank quantitative easing, but from the government-directed mortgage channel. The administration has effectively launched a large-scale program of agency mortgage bond purchases at the same time as markets debate the timing and size of further Federal Reserve rate cuts. That combination nudges financial conditions looser, even though the Fed itself is still running balance sheet reduction and signaling patience. Fannie Mae and Freddie Mac have already absorbed around $65 billion of mortgages over recent months and have scoped to take that up toward $200 billion under direction from the White House. The explicit aim is to pull mortgage rates lower and improve housing affordability while also supporting agency profitability. 30-year mortgage rates have already slipped below 6% to levels last seen nearly 3 years ago, and mortgage origination and real estate-related stocks have rallied on the announcement, even if the broader market reaction has been more muted. Market participants increasingly describe this as a form of mortgage quantitative easing, with the Treasury and housing agencies taking on some of the role traditionally associated with the Fed. However, futures pricing and term premia still indicate that investors do not expect the central bank itself to restart asset purchases anytime soon. The Fed continues to let its own mortgage holdings roll off, so agency buying is effectively offsetting that runoff rather than adding a new wave of liquidity, and there are still questions about whether purchase caps will limit the ultimate impact on mortgage rates. On policy rates, the forward curve still prices roughly 2 cuts over the year, but the odds of a January move are now very low, with some analysts pointing instead to March or even mid-year as more plausible entry points for easing. Recent data have been described as clean rather than weak. Payrolls are softening, but not collapsing, and wage growth is increasingly consistent with inflation converging toward the 2% target. That mix supports the narrative of a central bank willing to tolerate inflation slightly above target for a period in order to protect the labor market, and it has shifted the debate toward where a neutral policy rate might settle, with some arguing for a level near 3% over time. If the Fed ultimately delivers another 100 basis points of cuts, current estimates suggest the entire Treasury curve could shift lower, with 10-year yield potentially gravitating toward 3% and reinforcing the downward pull on mortgage rates. Combined with ongoing fiscal support, that would extend the run at hot backdrop for growth and corporate earnings. The risk is that markets have become too comfortable with the easing story. A pause to assess previous cuts or stronger data that pushes the first move further out could disappoint consensus and reprice duration-sensitive assets, especially in housing and rate-sensitive equities. Those tensions are most visible in the tightening narrative, where current policy remains restrictive and front-end markets are acutely sensitive to each new data point. Despite the focus on future cuts, today's policy setting is still restrictive, and that is where markets are feeling the most tension. Investors have generally preferred short-dated U.S. debt over the long end, reflecting uncertainty about how far and how fast the Fed will actually ease. Even relatively small surprises in inflation or employment now have outsized effects on front-end yields, the dollar, and risk appetite across equities, credit spreads, and foreign exchange. Recent labor prints have reinforced the ambiguity. Headline payroll gains have come in slightly below expectations, while one report showed the unemployment rate falling to around 4.4%, challenging the idea of a rapidly weakening jobs market. Private payroll data point to gradual softness rather than an abrupt downturn, and companies appear to be slowing hiring instead of aggressively cutting staff, which is broadly consistent with a soft landing or normalization narrative. At the same time, average hourly earnings running near 3.8% year-on-year suggest wage growth remains firm enough to keep some inflation pressure alive. Against that backdrop, the Fed is widely expected to pause at its next meeting. Market estimates put the probability of an imminent cut at well under 5%, with most forecasts clustering around 2 rate reductions in the second half of the year. Some policymakers have floated the idea of as much as 150 basis points of additional cuts over time, citing earlier labor market weakness and progress on inflation, while others argue that with the economy close to full employment, aggressive easing is not justified by standard rules. The rotation of new voting members on the policy committee only adds to the uncertainty. Several signals suggest front-end markets may be mispriced by as much as 50 basis points, leaving room for repricing if jobs or inflation come in stronger than expected. A robust non-farm payrolls report and a further dip in unemployment could push 2-year yields higher and flatten the curve, while also challenging equity valuations that currently lean on the prospect of lower discount rates. Strategists warn that strong economic surprises across the US, Europe, and China, which are supporting earnings expectations today, could turn into a headwind if they revive the prospect of renewed hikes or sustained higher real rates. Concerns about fiscal deficits and heavy government issuance add another layer, as they complicate the task of tightening without destabilizing markets. In response, many investors are building hedges around the possibility of policy mistakes or fiscal dominance, including allocations to gold and silver, digital assets, and inflation-protected treasuries, alongside selectively hedged U.S. equity exposures. The counterargument is that disinflation and moderating wage trends are gradually reducing the need for further hikes and still support the case for at least modest easing later this year. Long-dated treasuries yielding close to 5% are being viewed by some as attractive if the Fed cuts gradually, but markets remain extremely sensitive to 1 or 2 months of stronger data. Key watch points are payroll revisions, the trajectory of unemployment, upcoming inflation releases that may be distorted by earlier government shutdown effects, and the tone of communication from new Fed voters. Taken together with the geopolitical and mortgage dynamics we discussed earlier, this leaves a backdrop where spot conditions look contained, but the distribution of outcomes around rates, energy, and risk assets remains unusually wide. Stepping back, today's landscape combines benign spot conditions with significant optionality. U.S. engagement in Venezuela and a still oversupplied oil market are helping to cap energy costs, even as security and execution risks could still inject sharp volatility. Policy-driven support for housing via large-scale mortgage bond purchases is quietly easing financial conditions, while the Federal Reserve keeps rates restrictive and waits for clearer signals from labor and inflation data. That tension leaves front-end yields, the dollar, and valuation-sensitive assets highly exposed to each incremental data surprise. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.